Annuities are defined in part by the nature of their underlying investment platform. On this basis, there are two basic types: fixed annuities, including indexed annuities and market value adjusted annuities. Variable annuities. This lesson focuses on fixed annuities. Variable annuities are studied in a separate lesson. Fixed annuity defined. A fixed annuity guarantees the rate of interest credited to the contract. Think, the interest rate is fixed. This, in turn, lets the insurer guarantee a deferred annuities principal and an immediate annuities level income payments. General account supports guarantees. Fixed annuities can provide long-term guarantees of principal and interest because premiums are invested in the insurer's general account. General account funds are invested in safe, secure long-term assets such as U.S. government securities, blue-chip stocks, and investment-grade bonds. Fixed annuity accumulation. Fixed annuities are available as fixed premium deferred annuities, so-called retirement annuities, and flexible premium deferred annuities. In both cases, the annuity guarantees a minimum rate of interest credited to the account. Guaranteed minimum and current, declared, interest rates. Guaranteed minimum rates, which are usually in the range of 1 to 3% compounded annually, are fixed for the life of the contract. To be competitive, most fixed annuities today credit deferred annuities with the higher of the guaranteed minimum rate or a declared rate that reflects current market rates. Unlike guaranteed rates, declared rates are subject to change. Most insurers lock in the initial interest rate for a minimum period, for example, 2 years, after the annuity is issued. Beyond the initial rate period, renewal rates can be changed at any time, though most insurers limit changes to no more than once per year. Two-tiered fixed annuities. While it is not necessary to annuitize a deferred annuity, some insurers create an incentive to do so by offering two-tiered fixed annuities that reward those who annuitize with a higher rate of interest than those who surrender their annuity or take periodic withdrawals. Insurers maintain two parallel accounts for every two-tiered annuity, one with a higher rate of interest and one with a lower rate. If the annuity is annuitized, the higher rate values are used. If the annuity is surrendered, then the lower rate values are used, resulting in a smaller accumulated value. Fixed annuity annuitization. When a person buys a fixed immediate annuity, or when a fixed deferred annuity is annuitized, the funds are converted into fixed, level, periodic payments based on the chosen settlement option. Annuity payments are based on the annuitant's annuity purchase rate, APR, at the time of annuitization. Different for every age, gender, and settlement option, the APR is the amount of periodic income provided for every $1,000 of annuitized principal. Example: one insurer's APR under the straight life income option is $6.85 for a 65-year-old male and $6.50 for a female of the same age. This means that a $100,000 sum of money would generate $685 per month for the male and $650 per month for the female. Women's longer life expectancy translates into a smaller payment amount for any settlement option involving a life contingency. The two are considered actuarially equivalent. Deferred annuity death benefits. All deferred annuities provide for a death benefit if the contract owner dies during the accumulation period. The death benefit equals the sum of premiums paid, plus accrued interest, minus any previous withdrawals or charges. In other words, the annuity's current accumulated value at the time of death. Indexed annuities. Indexed annuities are fixed annuities whose growth is tied closely to the performance of a stock index, commonly the S&P 500. Indexed annuities participate in some of the growth in the stock market while avoiding the downside risks associated with equity investments, including variable contracts. They do so by linking the current interest rate to the change in an equity, stock, index. Providing for a guaranteed minimum rate of return. Participation rates and rate caps. The basic indexed annuity concept is simple. Annual changes in the selected stock index are the basis for determining the interest rate credited to the annuity. The percentage of the index increase actually credited to the annuity is called the participation rate. These rates typically range from 60 to 90% of the increase in the index. For example, If the equity index increases 6% and the participation rate is 80%, then the annuity will be credited with an interest rate of 4.8%, i.e., 80% of 6%. Most indexed annuities have a rate cap. A rate cap is the maximum interest rate that would be credited. A cap of 10%, for example, limits the amount of interest credited to the indexed annuity to 10% annually. Minimum interest rates. Indexed annuities have a guaranteed minimum interest rate that protects against the downside risk of traditional equity investments. The minimum interest rate guarantee, typically 1 to 3%, but as low as 0%, provides the assurance that the indexed annuity's principal is secure. Term. Indexed annuities typically have accumulated values can be taken free of surrender charge. Or, they can be left in the contract and the contract can be continued for another term. Of course, they may also be annuitized. Death benefits. Index-deferred annuity death benefits are usually the higher of the contract's accumulated index value or the guaranteed minimum interest rate value. Example. Long Life Insurance Company sells an indexed annuity that is tied to the S&P 500. It has a 75% participation rate and a 10% rate cap. When Earl bought his indexed annuity with a $10,000 premium deposit, the S&P 500 was at 1,000. At the end of the contract's first term, the S&P was at 1,150, i.e., 15% higher. The basis for the interest rate change, therefore, is 15%. With a 75% participation rate, the interest that would be credited to Earl's annuity would be 11.5%, i.e., 75% of 15%. However, this is greater than the rate cap. Accordingly, the interest rate credited to the annuity is 10%, i.e., the rate cap. Market value adjusted annuities. Some fixed deferred annuities are issued with a market value adjustment, MVA, provision. Because the MVA is a central part of the annuity, these are sometimes called market value adjusted annuities, MVAs. The purpose of the MVA provision is to discourage deferred annuity contract owners from surrendering their annuity and moving the money to a new annuity when rates are rising. The MVA provision permits the insurer to retroactively adjust the interest credited to amounts withdrawn, in excess of an annual free withdrawal limit, during the contract's surrender charge period. For example, if a contract permits charge-free withdrawals up to $2,500 annually and the annuity owner withdraws $4,000, the insurer will adjust the interest that was credited to the $1,500 excess withdrawal. Whether an MVA is positive or negative for the annuity owner depends on current interest rates at the time of the full or partial surrender. If current market rates are higher than they were when the annuity was issued, the MVA works to the contract owner's detriment by causing the insurer to reduce the interest credited to the surrendered amount. This effectively reduces the value of the withdrawn amount by more than the surrender charge. If current market rates are lower than they were when the annuity was issued, the MVA works to the contract owner's advantage by causing the insurer to increase the interest credited to the surrendered amount. This effectively reduces the surrender charge and increases the value of the withdrawn amount. In return for assuming the risk of a possible rate reduction if the annuity is surrendered before the end of its term, most MVAs reward contract owners with a slightly higher current interest rate than is credited to non-MVA fixed annuities. Key point. In no case will a market value adjustment reduce an annuity's effective rate of interest below the contract's minimum guaranteed rate. For your review. Fixed deferred annuities are available as fixed premium deferred annuities, so-called retirement annuities, and flexible premium deferred annuities. Fixed annuities can guarantee principal and interest, and, thus, level annuity payments for life, because funds are invested in the insurer's general account, which is based on conservative assets. Most fixed deferred annuities today credit funds with a higher of a contractually guaranteed rate and a current declared rate. As an incentive for owners to annuitize their deferred annuities, some insurers offer two-tiered annuities that credit annuitized funds with a higher rate of interest than what is credited to annuities that are surrendered. Different for every age, gender, and settlement option, the annuity purchase rate, APR, is the amount of periodic income provided for every $1,000 of annuitized principal. Deferred annuities provide a death benefit, equal to the fund value minus any prior withdrawals, if the contract owner or annuitant dies during the accumulation period. Indexed annuities are fixed annuities that allow contract owners to participate in some of the growth in the stock market while avoiding possible losses to principal, by tying their interest rate to the performance of a stock index. MVAs are fixed annuities that retroactively adjust the interest credited to amounts withdrawn during the contract surrender charge period. They discourage a contract owner from surrendering a contract and moving the money to a higher interest contract. Please pause the audio and watch the video. You can read
that annuities and life insurance are similar is in the nature of their underlying investment platform. Now, this and the next few lessons describe the various types of annuities, again, from their investment perspective, and they include fixed annuities, the subject of this lesson, variable annuities, and the more recent developments of equity indexed annuities and market value adjusted annuities. This lesson we're going to talk about fixed annuities. Really, I think the point we want to make here is the similarity between a fixed annuity and traditional whole life insurance when it comes to funding the contract. Both fixed annuities and whole life insurance feature a guaranteed death benefit. Of course, the life insurance death benefit is well understood. With a fixed annuity, the death benefit is actually just the deferred annuity contract value. There's an actual formula that's described in the lesson for how that's calculated, but for all intents and purposes, all you really need to know is it's the contract value, or literally by the formula, the amount contributed into the contract, interest earned on that, and minus any prior withdrawals. That is the guaranteed death benefit. Like whole life insurance, fixed annuities invest the contributions, the premiums, into the company's general account. And that allows for contract values to be guaranteed. And most deferred annuities today really guaranteed to pay the greater of a truly guaranteed rate, which might be around 3%, depending on the contract, or a declared rate, which would be higher in a higher interest environment. Those similarities aside, there really is, and more importantly, some significant differences that we want to very briefly touch on, and that is the tax treatment of withdrawals. As noted in prior lessons, withdrawals from the cash value of a whole life insurance policy is treated on favorable FIFO, or first in, first out basis, which simply means the withdrawals are considered to be first a return of the policy owner's money, and only after the principal amount is withdrawn is any subsequent withdrawal from the cash value treated as taxable gain. Now, this assumes that the life insurance policy is not a modified endowment contract, which we discuss in a separate lesson. With a deferred annuity, the withdrawal from the contract is treated on the less favorable LIFO basis, last in, first out, which simply means you start taking money out of that deferred annuity. For tax purposes, it's treated first as a distribution of taxable gain, and only after that gain is distributed are any subsequent distributions treated as a tax-free return of principal. So if you understand the similarity and the difference between whole life and a fixed annuity, that'll help you understand, again, the funding of the fixed annuity.
Okay, so here is our 4 questions. I'm going to answer them by myself since this is not live. Again, as I state in almost all my videos, if you would like to see this done live, then you need to comment below. If I don't get no comments, then nobody's interested and I'm not going to do these questions live. The benefit of doing this live is you can help each other answer these questions and it would help you study. So consider that. And also consider subscribing and please like the video. And now done with all of that, let's move on. Which of the following correctly describes an index annuity contract owner's option at the end of the contract term? Either surrender the contract free or renew it. Surrender, renew, or annuitize the contract. I'm going to say this one. For Mary, who is preparing to annuitize her fixed deferred annuity, every $1,000 of annuitized principal will produce $6.33. $6.33 represents the I don't know, I couldn't remember what he said. I know he had an example in here. Alright, when does a fixed deferred annuity contract provide a death benefit? Only if the contract owner or only if the annuitant dies after the contract is annuitized. I would say the first one. I have no idea what's right here because I wasn't paying attention. My bad. Okay, under a market value adjusted annuity, an interest rate adjustment may reduce the annuity's effective rate of income, rate of interest, as low as the contract's minimum guaranteed rate of interest. Alright, let's see how we did. Holy crap, I need to take a picture of this. Talk about some good guessing. I hope I guessed like this on the test. Alright, apparently I got 100%. I'm taking a picture. Alright, so for the end of the term, the owner can surrender the contract free of surrender charge, renew the contract, or annuitize it. The annuity purchase rate is the amount of periodic income that $1,000 of contract value purchases. Some of these questions may be on your test, so if you need to review this video again, review it again. Alright, so the next one is, when does a fixed deferred annuity provide a death benefit? Only if the contract owner or annuitant dies during the accumulation period. The next one is, for the market value adjusted annuity, an interest rate adjustment may reduce the annuity effective interest as low as the contract's minimum guaranteed rate of interest. Okay, so for our next lesson, we're doing variable annuities. We just finished fixed on this one. So I'll see you all in the next video. Thank you for watching.